Interest rates. You hear about them all the time. The Fed raised them, the Europe Central Bank cut them. But what do they actually do to the markets, and how can we use that to trade smarter? Today, I'm breaking down how central bank interest rate decisions move forex, stocks, and even crypto. This is essential if you're serious about trading or just want to understand the real forces behind market moves. Let's start simple. An interest rate is the cost of borrowing money. When central banks, like the Federal Reserve in the United States or the European Central Bank in Europe, set rates, they influence everything from mortgage payments to the value of currencies. High interest rates usually mean money is more expensive to borrow. That slows down the economy but strengthens the currency. Low rates make borrowing easier, which can stimulate growth but weaken the economy. Why? Because higher rates attract foreign investors looking for better returns. That increases demand for the currency. If you are a forex trader, this part is gold. Let's say the Fed hikes rates while Europe Central Bank keeps them low. What happens? The United States dollar grows against the euro. This isn't just theory. The majority of major forex moves in the last 10 years are closely tied to rate differentials. Smart traders pay attention to the central bank tone, hawkish versus dovish. Hawkish means tightening and raising rates. Dovish means easing, lowering rates. Even expectation of a change can move the market. What about stocks? Generally, high rates means bad for stocks growth because borrowing is more expensive. Lower rates means more money flows into equities. But here is the twist. Sometimes markets go up on rate hikes if the hike was expected and signals confidence in the economy. Understanding the context is everything. There are 4 major central banks every trader watches: Federal Reserve, European Central Bank, Bank of England, and Bank of Japan. Also keep an eye on Reserve Bank of Australia and Bank of Canada too. Each has regular meetings and rate statements. These are gold mines for market moving opportunities. Here is how I prepare before every major rate decision. Check forecasts. Sites like Forex Factor or Trading Economics show expected rate changes. Read central bank statements, not just the decision but the tone. And look for divergence. Is one country raising rates while another is cutting? That's a setup. Let's say the Fed surprised the market with 0.5% rate hike. What happens? United States dollar grows, gold falls, and risk currencies like Aussie dollar or New Zealand dollar drop. Your trade idea could be, for example, buying United States dollar versus Japanese yen, targeting some highs. That's the power of understanding interest rates. They're not just news, they're signals. Learn to trade them and you will trade with the banks, not against them. Drop a comment if this helps and subscribe for more high-level breakdowns like this. Until the next time, have a nice day and nice trading.